Welcome you all. Myself Dr. B. Nandini, Assistant Professor of Commerce. In this video, I am going to explain how to compute the capital gain. Before you directly going on to the capital gain, first let us know what is capital asset. The capital asset means the assets which are held by the assessee for a period of more than 36 months. The profit arising on sale of such capital asset are taxable under the head capital gains. The capital gain is chargeable to income tax if the following conditions are satisfied. That is, there should be a capital asset and it must be owned by the assessee in his own name, and it should be transferred during the previous year, and there should be a capital gain or loss on account of such a transfer of capital asset. Now we are going to see about the assets which are included or taken as capital asset. Capital asset may be movable asset or immovable asset, tangible asset or intangible asset, circulating or floating asset, whether or not connected with the business or profession. However, the term capital asset does not include the following. Number 1, stock in trade, that is the assets which are held by the assessee as a stock in trade are not taken as a capital asset. Personal effects of the assessee, that means personal use excluding jewelry, costly stones, silver and gold. Number 3, agricultural land in a rural area, that is an area with a population more than 10,000. Number 4, 6.5% gold bonds 1977 or 7% gold bonds 1980 or national defense bonds issued by the central government. Number 5, special bearer bonds issued by the central government and the gold deposits issued under Gold Deposit Scheme 2000. Next, we are going to see about what are the kinds of capital asset. There are two kinds of capital assets. Number 1 is short-term capital asset and number 2, long-term capital asset. Short-term capital asset means the assets which are held by the assessee for a period of not exceeding 36 months in case of the movable and immovable assets, and in case of the shares, debentures and securities which is held by the assessee for a period of less than 12 months is called as short-term capital asset, and the profit or gain arising from transfer of such a capital asset is termed as short-term capital gain. Next, what do you mean by long-term capital asset? It means a capital asset which is not a short-term capital asset. A capital asset which is held by the assessee for a period more than 36 months is called as long-term capital asset. However, if the capital asset is in the nature of equity capital, is called as a long-term capital asset if it is held for more than 1 year, that is more than 12 months. Next we are going to see about the term transfer of capital asset. The term transfer includes sale of asset, exchange of asset, relinquishment of asset and extinguishments of any right on assets and compulsory acquisition of asset. The definition of transfer is inclusive, thus the transfer includes only said above 5 ways. In other words, the transfer can take place only in these 5 ways. if there is any other way where an asset is given to other, such as by way of gift, inheritance, etc., will not be termed as transfer. Next, we are going to see about how to compute the short-term capital gain. For that, first we have to take into account the sale proceeds of such asset, and from the sale proceeds we have to deduct the cost of acquisition, cost of improvement, and expenses on transfer. If you are deducting these three items from the sale proceeds, we have the capital gain, that is called the short-term capital gain or loss. Next, we are going to see about how to compute the long-term capital gain. The income tax authorities may give an option to convert the cost of acquisition and cost of improvement into the present value in order to avoid the more amount of tax payable by the assessee in case of long-term capital gain. Now the format is, that is, in order to find out the long-term capital gain, first we have to take the sale proceeds of an asset. From that sale proceeds we have to deduct the expenses on transfer, indexed cost of acquisition, and indexed cost of improvement. If you are deducting these three, we will arrive the long-term capital gain. How to compute? Now we are going to see about how to compute the indexed cost of acquisition. It is nothing but we have to convert our cost of acquisition into the present value. For that, they are providing the index number to convert their cost of acquisition to the present value. So the formula for finding out the index cost of acquisition is cost of acquisition divided by cost inflation index for the year in which the asset was acquired into cost inflation index for the year in which the asset was transferred or sold. Next, we are going to see about the formula for finding out the indexed cost of improvement. Likewise, the indexed cost of acquisition, we have to find out the improvement also indexed. It is the formula is cost of improvement divided by the cost inflation index for the year in which the improvement took place into cost inflation index for the year in which the asset is sold. If the improvement is taken before 1/4/2001 is ignored, the cost of acquisition before 2001 and 2 means, that means if the asset is acquired by the assessee before 2001 and 2 means, in order to find out the indexed cost of acquisition, we have to take into account the cost of acquisition or the fair market value on 1/4/2001, whichever is higher. And likewise, if there is any improvement took place before 1/4/2001 means we have to ignore this one, because the income tax authorities introduced the index cost is from the year 2001 and 2. Now I am going to give one example how to compute the long-term capital gain. For example, in this example, the sale proceeds of a house property is 25 lakhs and the cost of the property is rupees 1 lakh, and which is purchased on 30th March 1998, and the fair market value of the house property on 1/4/2001 is rupees 4 lakhs, and the cost of improvement undertaken in the year 1990 for rupees 50,000 and in the year 2014 rupees 2,40,000. You are asked to compute the long-term capital gain. For that, first we have to take into account the sale proceeds. From the sale proceeds, we have to deduct the indexed cost of acquisition. For finding out the indexed cost of acquisition, first the formula is cost of acquisition or fair market value on 1/4/2001, whichever is higher, divided by cost inflation index for the year in which the asset was acquired, or 1/4/2001, whichever is earlier, into cost inflation index for the year in which the asset was sold. Here in this example, the cost of acquisition of the property is rupees 1 lakh and fair market value on 1/4/2001 is rupees 4 lakh. So among that two, 4 lakhs, that is the fair market value, is higher. So we have to take into account the cost of acquisition as rupees 4 lakhs divided by 100, that is 2001 and 2 as the base, into the asset transferred is in the year 2023. So that's why we have to take into account the index number for the year 2023, that is 331. So the indexed cost of acquisition is rupees 4 lakhs divided by 100 into 331, that comes to 13 lakhs 24,000. And the improvement took place in the year 1990 was ignored, and in the year 2014 was taken into account, and it was also converted into the indexed cost of improvement. For that, the formula was cost of improvement divided by cost inflation index for the year in which the improvement took place into cost inflation index for the year in which the asset was sold. So the amount is 2,40,000 divided by 240 into 331, that is 240 means the inflation index number for the year 2014. Hence the cost of improvement comes to 3,31,000. So the sale process is 2,50,000. From that, the indexed cost of acquisition is 13,24,000 and indexed cost of improvement is 3,31,000. So if you are deducting this one, the amount is deductible is, that is the cost of acquisition and cost of improvement both are combined as 16,55,000. So if you are deducting that one from the sale process of 25 lakhs means we will obtain the 8,45,000 rupees as a long-term capital gain. In this problem, there is no expenses incurred on transfer of such asset, so hence it is taken as nil. Thank you.